Hey, Steve Saretsky here. Welcome back to the show. I want to touch on a few things this week before we get into the Bank of Canada expectations for their rate announcement next week, which everyone is watching very, very closely. But I want to touch on some comments, first and foremost, from our dear leader, JT, Justin Trudeau. He did a podcast interview with the Globe and Mail, and there was an article that was published shortly thereafter from the Globe and Mail saying, quote, Trudeau says real estate needs to be more affordable, but lowering home prices would put retirement plans at risk. And so basically, he said the quiet part out loud. You are not supposed to say that as a politician. Affordable housing, house prices are supposed to come down. So there's a little bit more of to expand on his quote. He said, housing needs to retain its value. It's a huge part of people's potential for retirement and for their future nest egg. Those are his comments, not mine. Now, again, a lot of people are getting extremely frustrated by that, but it's really like one of the core themes that I've been talking about this channel for like 4 or 5 years now, especially during the onset of the pandemic when housing pricing was ripped and they were juicing it and letting people defer their mortgages and we are printing all this money at the central bank level. This was one of the things that I said. And the reason for that is like, it was that old quote that, everybody wants affordable housing, but nobody wants their house to become affordable. The reality is housing is most people's entire retirement plan, savings. It's the one free tax advantage you get in this country. No politician, whether it's JT or Pierre Poilievre, is getting reelected if national house prices drop 30% across the board. That comes with huge losses at the banks. Credit seizes up. Jobs get lost. People lose jobs. They end up in the food bank lines, and it's pretty hard to get reelected under those circumstances. So you're kind of walking this tightrope, which is at the end of the day, house prices go up. 65% of people own a home. That fuels a wealth effect. That fuels additional consumption. And that is really what drives your economic and GDP growth. Again, right or wrong, housing is largely responsible for that. You then have to think about the tax revenue base, right? Think about this. This is a federal government that is spending their brains out. In fact, we just heard this week, the federal government, remember, Christopher Freeland, the finance minister, said, we're going to have this fiscal anchor. We need to get inflation down. We have this fiscal anchor. We're going to have the deficit running at $40 billion, and we're not going to exceed $40 billion. Well, guess what? We just had the numbers out this week that says the deficit is projecting around $50 billion. So she's already missed this fiscal anchor. And so the government is desperate for tax revenues. Why do you think they brought in the increased capital gains inclusion rate that's supposed to be enacted this summer? Again, the government is desperate for revenues. And think about the revenue base in Canada. What does it have going for it other than real estate? Real estate in the form of capital gains taxes being paid. You sell an investment property, et cetera, values go up. As values go up, those are tax revenues. Property transfer taxes to provincial governments. Municipalities receive their tax base through property taxes. So as values rise, they tend to accrue more taxes from that. They charge developers development cost charges, DCCs, levies, all these fees that come from the transactions and the value of real estate going higher. Now, I will say, when we talk about the value of real estate, so much of this is just this fiat currency Ponzi-esque debasement, which is really like, are house prices really going up, or is your value of your currency just being slowly eroded over time? And so you can call it CPI inflation. You can look at the CPI basket, or you can simply look at asset prices. And in many, like if you study historical examples of inflation and debasement and collapses of civilization, a lot of times that inflation showed up in asset prices, okay, such as real estate. Money gets pushed into real estate as a safety mechanism to store wealth, is a preservation of capital. And so as you enter into these inflationary debasement scenarios, you tend to actually see that in asset prices, again, aka real estate. And I've always pointed people to say, guys, this is just something to consider. I'm not saying it's right. I'm not saying it's wrong, but it's something that I use around for my framework is look at the prices of Vancouver real estate where I'm located, price them in ounces of gold. And you can see that the question is, how many ounces of gold does it take today versus 5 years ago, 10 years ago, 30 years ago? How many ounces of gold does it take to buy the average home in Greater Vancouver? And we can see that it's actually taking fewer and fewer ounces of gold to buy real estate, despite real estate roofing over the last decade, basically doubling. And this is basically showing you that you have this erosion of the currency. You have asset price inflation that is showing up in real estate valuations. And this is the main mechanism. So when they say, real estate must retain its value, it needs to retain its value because they need to maintain the existing financial system, which relies on credit continuing to grow. Credit, the banks, when they issue loans, when they issue mortgages, they create credit, and credit is what drives economic growth in the economy. And so if the asset value that the banks are lending against starts to fall, let's just say it falls 30% across the board, that's the bank's collateral, that's their security. And so what happens then is the assets basically that the bank has lent against are falling, and all of a sudden it impairs their ability to issue new loans because the banks have, we call it tier 1 capital ratios that they have to sort of meet. And so this is basically the gist is they need to keep the system going. So they need to kind of have continually rising home prices and so it's kind of a joke really when they say, hey, we need affordable housing and we're actually going to build our way out of it. Well, guys, we've talked about on the show for the last 6+ months is what's happening to housing supply. It's crashing. It's getting crunched. It's getting absolutely crunched as interest rates rise. It's killing off capital investment into new housing. The federal government, meanwhile, continues to pile drive 1 million+ people a year into this country. The population is expanding at the fastest rate it has in basically 70 years. And so he says we're going to make housing affordable by building out of it. It's a lie. There is no such thing as affordable housing. It's kind of this political fiction or fairy tale that they tell the average person that they're doing something. And you can kind of see, again, the Freudian slip that, oh, well, we need to maintain values, but we're going to create affordable housing at the same time. And it's like, well, no, if you want affordable housing, the prices need to drop. And they can't really allow that to happen in the existing monetary system that is all based on ever-growing piles of debt. And so I find that really fascinating. Again, keep in mind that JT is growing the population by 3% a year. Now, we just had the latest figures this week on GDP growth. And so, everyone's kind of watching this number. Are we going into recession? Is the data soft enough for the Bank of Canada to start cutting, right? Maybe we're going to cut here in June. Well, GDP on an annualized basis in Q1 came in at 1.7% annualized in Q1. That's below the Bank of Canada's forecast for 2.8% growth. So, wow, I mean, that's a huge, massive miss on the Bank of Canada's forecast. It just adds to speculation around rate cuts. But more importantly, so we saw the Bank of Canada, the market odds are now 80%. So markets are pricing, financial markets are pricing, they're betting there's 80% odds of a rate cut from the Bank of Canada next week in June after the latest string of economic data. But more importantly, again, 1.7% annualized growth, just to highlight how weak that is. Remember, I just told you the population's been growing. It's been growing at 3%. But your economy is only growing at 1.7%. So on a net basis, your economy is contracting on a per capita basis. In fact, it's now been contracting for 7 straight quarters. 7 straight quarters of real GDP on a per capita basis declining. So if your living standards feel like they're not getting any better, they're maybe getting a little bit worse, if it feels like it really hasn't gotten any better, well, it's because we actually have pretty much a lost decade in this country. If you look at a chart here from National Bank showing that there's been virtually no growth in the Canadian economy for the past decade, really ultimately since the current government got into power. And again, I'm not saying that it's all their fault and this is the only reason why. No, I mean, the Canadian economy has a lot of structural problems. I mean, certainly I would argue that the current federal government is not helping. They are certainly, I think, poor economic actors, poor policymakers. But there's been a lost decade in Canada. And I think it's a concerning trend. I mean, you've got really unaffordable housing, people starting to contemplate leaving the country. You've got weak economic growth. You got a lot of debt. And so they're just seeing, again, the government saying, well, we got to keep housing affordable. So this is what I think here is we're going to probably get a rate cut from the Bank of Canada. In fact, we had Doug Porter, BMO's chief economist, on the Loonie Hour this week. His view is a rate cut from the BOC in June. I went alongside Doug. I think if it doesn't come in June, it's coming in July. The only, again, issue is the data in the U.S. simply not weak enough where the Fed isn't going to cut in the States. So basically, your question is, how much can the BOC actually cut if the Fed, and most likely the Fed not moving, how much cuts can the BOC get before they basically can't go any further? And, depending on what economist you ask, it seems to be anywhere between 50 and 100 basis points. So that kind of gives you any indication. If you're sitting there on a variable rate mortgage and you're wondering how much mortgage rates are going to come down, you're wondering how much debt you got and how much you need to get rid of, you're going to be stuck most likely in this higher for longer environment. Is 50 basis points of rate cuts this year from the BOC going to reignite and kickstart the housing market? I don't think so. That's still going to leave your variable rate mortgage in the mid to high fives. That's going to be a painful adjustment for a lot of people. Now, could you get a little bit of a bump here in the summer months because there's some optimism, some sentiment changing? It should get a few people off the sidelines as that rate cut announcement comes out. But I think as it kind of filters out, you look at it and say, well, hold on a minute, rates are still going to be pretty high. So I think that sentiment, while you could get that initial pop, it should start to wear off. Now, I will say this on the housing market front. The market is slow. This is a slow housing market. You started off the year pretty hot on the expectation. Again, markets price in 6. They priced in 6 cuts from the BOC this year. I don't think we're getting anywhere close to that. That optimism slowly pulled and faded out of the market. Inventory is now finally starting to build up, and we're seeing real softness in the housing market. I've equated this that it feels to me, boots on the ground, feels a lot like summer of 2022, which was basically the market completely died because the Bank of Canada started raising rates, not just by 25 basis points, but you remember in July of 2022, they were raising rates by 100 basis points at a single meeting. People were freaked out. Everyone was wondering how high rates would go. The market activity completely died off. And today, it kind of feels pretty similar to that. Housing market activity has really tapered off over the last 6 weeks. But again, remember, the quiet part out loud, Justin Trudeau, housing must retain its value despite him campaigning on affordable housing and pulling out all these stops, creating a housing catalog. Guys, that isn't going to do anything for you. This is the real Freudian slip that, the Ponzi-esque dynamics of the fiat currency world continue to play out. And again, I would point you to the home prices in gold. You can do it in home prices and S&P shares. You can do it in anything tangible. I mean, the fiat currency is just a promise from the government. It's just an exchange of basically digits on a keyboard. There's no tangible backing behind a fiat currency. And so I continue to look at asset inflation just as another form of inflation or debasement. And I think we got more evidence of that this week. And we might get more evidence of it from the Bank of Canada next week that they need to cut simply on the basis to maintain the existing system. And the only thing holding them back right now is the Fed. So, as always, hope that helped. See you next week.